Joining me right now, one business leader is Starwood Capital Group Chairman and CEO Barry Sternlicht is with me now. Also joining the conversation all morning long is Dagan McDowell and Brian Brenberg. Great to see everybody this morning. Barry, thank you so much for being here. Good to see you.
You too. Good to see you. Thanks for having me, Maria.
I want to ask you about your SPAC, all that you've been doing in terms of investing, but let me start off with getting your take on the reopening of the economy, getting back to business. How does it feel to you now in October after the 7 months that we've been at home?
The basic economy is doing really well. You know, the manufacturing sector, obviously the markets are buoyant, consumer confidence is decent, the home the wealth of the household is at record highs, and the single-family home market's been like on fire. So the economy feels pretty good, except for those really impacted sectors, and that's where the unemployment remains in the tourism, lodging, travel industries, and sports venues, and shows and clubs. So you can see exactly how we get the unemployment rate down. We have almost 3 million unemployed hospitality workers right now, and they're bearing the brunt of this coronavirus right now. So, you know, the GDP print for the quarter is going to be like up 30%. That's after being down 30%, but right in front of the election. That's going to look really good, like we're going back to work. It's so interesting to see how the country is evolving. It's the traumatized Northeast is way behind the rest of the country. If you take, for example, the office markets, you're 40% occupied in Dallas. You're only 12% occupied in Manhattan. So, you know, where the coronavirus really hit hard, it's actually delaying the recovery of some of these cities that, you know, that were most impacted by the coronavirus. So it's an uneven recovery, you know, and the energy markets have kind of stabilized, but they're down on the year. But the economy is doing, I think, much better than people might have thought. And you know exactly how to get the rest of these people, how to get unemployment down another couple of points would be to open up the economy and let people travel again. And I think that's really interesting today.
Well, I mean,
go ahead.
What about real estate, Barry? I mean, I feel like it's a mixed story. You've got home sales strong, while you know, other areas, commercial real estate is in trouble in some areas of the country, right? What's your take on real estate? Because I know some managers are saying, we don't need the space that we once needed. And when you look at corners of the country like New York, people are fleeing homes. They want to sell their apartments, sell their homes because they're worried about security.
Yeah. Well, I think that's true. I think law and order in the big blue cities, Chicago, New York, San Francisco, you know, are going to be very important in the voting coming up. And on the other hand, I think these cities are resilient, but it'll be years before they recover on their feet. So, you know, from our perspective, where we invest and we predict very slow recoveries, and I'm not sure you've hit the bottom in these. San Francisco and New York are probably the Category 5 hurricane cities right now. I mean, San Francisco, I think almost 20% of the office space downtown is for sublease. And I expect rents will drop precipitously in the CBD. It actually will be better in the suburbs because people think it's safer and they don't have the issues of crime and homeless and things like that I think have made living downtown difficult. But you are seeing people flee. Wealth is fleeing these cities. Also, the popularism of taxing the wealthy forever and to all their net worth is scaring the daylights out of these people. And when these CEOs leave, so will go the jobs. And I have dozens of friends that have left Silicon Valley for Austin, and even for Austin, Texas, and even Miami. So I think that's a trend that will accelerate probably under the Biden administration. It'll force people. You'll be talking about 60+% tax rates. And I think people will examine, if they can, where they want to live. And obviously they can live in tax-free states, which are growing rapidly and are working on welcoming these people from these places. I think, look, the real estate markets are very complicated right now. The apartment market and single family are fairly good. I mean, you have very good collections. Occupancies are holding up. There's an issue in cities like New York, San Francisco. Again, you know, rents are falling, occupancies are rising. But in the heartland, when we own 80,000 apartments, and we're doing just fine. You know, like we have about 97% collection rate, and people are paying. And the industrial markets are great. And so you have those two green light categories. You have the office market, which is yellow. It's different by different cities. And you have credit tenants, they're paying you. Like I think our collections are 98%. So the office markets, though, what will be the renewal rents? Will they renew? It depends on where you are. And like we just sold a building in Raleigh, and we got a price that was equivalent to pre-COVID. And we have some buildings in downtown Boston, and they're doing fine. And then you get to the two red light. Hotels and retail are like, category 5 hurricane asset categories right now. And hotels in particular will come back, but we need travel to come back.
Let me ask you about your special acquisition purpose company. SPACs have done incredibly well. The IPO market doing very well. Tell us about allocating capital and what's behind this positive response from investors to things like SPACs and IPOs.
Look, the markets are extremely frothy, and Wall Street does everything to wretched excess until the markets say stop. And you've had, in the beginning, SPACs were kind of sponsored by broken hedge fund managers and bankrupt private equity guys, and a lot of us stayed out of the market. And today, you've seen higher quality people enter the market and sponsor SPACs. I'd put ourselves in that category. What we're doing there is not real estate. We're looking for growth opportunities, and we've danced with a lot of companies, some of which have actually gone public with other sponsors who are talking them up to levels that they don't belong at. So, I think the market is fairly undisciplined right now. There are some real charlatans playing in the SPAC market. The markets are indiscriminate. If they like your name, they take your stock up. They don't have any idea what the financials are. They have no idea what the competitive advantages of these companies are. They don't understand anything except the name of the company. So you are seeing the worst behavior in some of these SPACs. I'll take Nicola as an obvious example. I mean, companies didn't really have a product, no revenues, and hit over $30 billion in market cap. And Fisker was another doozy, a company that failed, in its life, but comes back as a SPAC at a $3 billion valuation. So it is not the most disciplined corner of the market. Having said that, it is a very viable way to go public, and I think we can compete very successfully against an IPO. And I think another guest said that there's been, of all the IPOs this year, they've mispriced by 42%. So the IPO process is sort of screwed up, and the SPAC is an answer to that, and teamed with a good sponsor who does due diligence on the company they're buying. And we've probably looked at over 100 companies, and several of them have chosen that we turn them down at cheaper prices that they're going public with. And then, of course, there are lots of negotiations with the sponsor over how to split economics and the lockups. And so, I mean, buyer beware. These aren't all good companies. And some of them I'd say, are treacherous, generally train wrecks. We're trying to find something that we know will be bigger and better in 5 years. That's our goal. It'll be bigger and better, because I don't want to sell this.
Real quick, you said the market's frothy. Do you expect that we're going to see a sell-off? And would something like a Biden presidency with his $4 trillion in tax increases spark a big sell-off in stocks?
So my comment recently was that I thought if the Democrats swept, that would mean that corporate tax rates and capital gains tax rates would increase. And given the run-up in stocks like Tesla and Apple, it would be kind of crazy for people, 400% increases this year in Tesla, for not to take capital gains this year. So I thought you'd see a sell-off near term in these the highest flying stocks, mostly tech, that have rallied to extreme levels that are, 100, I think Snowflake is 172 times revenue. So those stocks, you probably take a temporary hit. And I think the whole market has to adjust to a corporate tax rate that's going to see, they're talking about 28% up from 21. By definition, that would pull the market down. Offsetting that is the scale of the stimulus package the Democrats are talking about passing, which, by the way, will really hurt unemployment. It will not. We cannot get people at $600 benefits to unemployed. It's too high. The Republicans are right at $400, and you can't give people more money to stay unemployed than when they were working. So I hear this all over the country. I see it in our hotels, and it's a really bad plan of the Democrats. The $1,200 isn't needed either, but $1 trillion or $2 trillion cash flooding through the markets is going to overwhelm probably the tax increase in the short run. The markets may continue to rally.
I see.
And even though I think we're eating too many sugar donuts.
Barry,
we're like, this is not a healthy way to run the economy.
Thank you so much, Barry. Great analysis, Barry Sternlicht. I wish we had more time, Barry. We'll see you soon, Barry Sternlicht.